You do your research, you wait for the perfect positive news cycle, and you buy the stock. Almost instantly, the price plummets. Or you get stopped out of a position at a loss, only for that same asset to snap shut and skyrocket the very next day. Most traders dismiss these moments as a run of bad luck. However, the mathematical consistency of these losses suggests something more deliberate, a market architecture designed specifically to hunt retail positions. To see the mismatch, we have to look at who is actually driving the bus. This pie chart reveals the disparity in volume. Institutional capital, the smart money, controls 70% of the market's movement. Retail traders hold just 25%. And those controlling institutions aren't guys in suits yelling on a trading floor. As this graphic shows, 75% of U.S. equity trading is now executed by high-frequency algorithms operating in milliseconds. Trading manually based on your gut is the equivalent of bringing a knife to a robot gunfight. Standard, emotionally driven retail strategies are walking right into mathematical traps designed to capitalize on human latency. Markets operate on a highly engineered chronological cycle. On this timeline, the playbook begins on the far left, with Phase 1, accumulation. Then, algorithms move to Phase 2, testing, an active probe of supply and demand, designed specifically to clear out retail hands. Large institutions face a major logistical hurdle, their sheer size. If a hedge fund drops a $100 million buy order onto a public exchange, it would instantly trigger a price spike that ruins their entry. To bypass this, they divert nearly half of their total trade volume into private off-exchange networks, known as dark pools. They build their massive positions in the shadows, while the public tape remains completely flat. While institutional moves are hidden, retail activity is perfectly visible. By purchasing payment for order flow data, firms gain a real-time map of the public's positions. As this diagram details, they can see exactly where retail traders have placed their safety stop losses. With that map in hand, the hunt begins. Institutions intentionally drop the price to trigger those stop-loss clusters. As the text here points out, that sudden retail panic creates perfect exit liquidity, allowing smart money to absorb cheap shares without moving the broader market. When you get stopped out right before a rally, it isn't an error in your timing. It is the result of a deliberate, manufactured markdown. Once fully loaded at a discount, the cycle shifts to Phase 3, markup. Institutions release positive catalysts, and algorithmic buying rapidly spikes the price upward. That sharp move leads into the final stage, Phase 4, distribution, aligning perfectly with peak public excitement. Faster, more energetic. At the peak of this chart, that algorithmic price spike acts as a flare gun, setting off retail stock scanners across the country. Traders see the green candles and buy in aggressively, driven by a fear of missing out. This wave of incoming retail cash provides the exact liquidity institutions need to exit. They use your buy orders to offload their overvalued positions. It all leads back to this market axiom. When the public is greedy, the institutions are distributing. The retail trader acts as the final step in the institutional life cycle, buying the exact assets that smart money has already finished extracting value from. This graphic captures the dichotomy between these two players. Retail traders lose capital because they react to lagging news and emotions. Institutional wealth compounds because it relies on deep quantitative research and patient, data-driven anticipation. It is impossible to win on speed or access. No human clicking a mouse can outcompute an algorithm, and you will never see the private dark pools or alternative data feeds that institutions pay millions to secure. Survival requires shifting the battleground away from the chaotic public ticker. If you cannot win on speed, you must stop serving as the liquidity that allows institutions to exit their trades. This shift means moving from reactive trading to structural alignment. While you cannot beat the machines in milliseconds, you can recognize the 4 distinct phases they must pass through and align your trades with the footprints they leave behind. Success in this environment requires accepting that the market is a manufactured machine. You cannot stop the waves it creates, but once you identify the blueprint, you can begin to ride them.